Today we'll take a look at the Taiwan Semiconductor manufacturing company. We are going to take a look at the fundamentals of this company, and we're going to make my assumptions about the future and use the stock analyzer tool and find out how much we should be paying for TSMC. I just pulled up TSM here in the Everything Money software, amazing software, go get it. TSM's market cap is over $500 billion. It's going to be harder for this company to grow when the market cap expands, because if your money has to double, well, then the underlying business also has to double, which means the stock price also has to double, and that would mean that, well, this market cap would have to double. So you just have to think about, like, at which point does it get ridiculous with the market cap, right? How many times can we double the company, double the size of the business? That is why when we look at these large cap stocks, we put in some lower growth estimates, some lower PE ratios, future PEs, because Apple is just not going to triple in the next 3 years, because, well, then it would be like a $6 trillion market cap or something, even more than that. So we have to take that into account. They have a price to sales of 10, which is their price divided by their revenue. And we have a PE ratio of 26. That has been a lot higher. You can see here the past 5 years, it has been an average 36. It has been trading at a higher PE, which means, well, people are apparently willing to pay more, have been willing to pay more in the past years. So maybe we could use a pretty high PE when we go to the stock analyzer tool to calculate our price estimate, a price target. Something that TSMC is pretty good at is their return on equity, 30%, and their return on invested capital. Over the past 5 years, that has been 10%, which means when you invest, they're going to be able to use that investment to grow the business with an average 5-year return of 10% on that money that you invest. So they have a gross profit margin of 51%, and their profit margin is actually pretty high, laying at 37%. So one thing that I don't like as much about TSMC is the fact that they pay out this dividends, and it is not even that high of a dividends. It's 1.7%. But the thing is that the dividends paid is $9 billion that they used, and they can just afford that with their last year's free cash flow. The 5-year free cash flow has been lower. So basically what they've done, their revenue, their free cash flow increased the last year because of semiconductor shortage. Then their cash flow has increased a lot this past year. They've paid all of their cash flow out through a dividend. And I think that they should actually be reinvesting into the business, or paying down debt, or making other acquisitions, or buying back shares. And I don't really like that they pay out everything that they make through their dividends. So that is a concern. So that is something that I personally don't really like, because if I were to buy a dividend stock, then I probably wouldn't buy this one, because it's a 1.7% dividends. Now let's go to the income statement here to see if they're growing their revenue, growing their numbers. We want to see that revenue growing, of course, and we can see it went from 34 billion to 55 billion in the past 5 years, so massive check mark there. We want the number of outstanding shares staying the same or decreasing, and we can see the past 5 years it has been the same, which means they are not diluting their shareholders by issuing more shares to their shareholders. They are not buying back any shares either. I think it would be much better. I would much rather have that they used that cash flow to buy back their shares, which then could give me as an investor a higher stake in the business. If a company has 10 outstanding shares and you own one of them, then you own 10% of the business. But if they buy back 2 of those shares, now you still have your 1 share, but that share is now 12.5% of the business, which means your ownership just got increased. And the thing is, you don't have to pay taxes on that ownership increase, but on the dividends, you do have to pay taxes. When you get it out, then you can reinvest it, but you have to pay taxes, and that is a problem, and you have to pay the fee when you invest, the transaction fee and all these things. I would much rather have them just buying back their shares, but still we want them to buy back shares at a good price, and right now maybe arguably TSMC is a little bit overvalued. Their total long-term assets is $58 billion, and yeah, they only have 10 billion in long-term liabilities, so that is very well covered. No, actually, we haven't got data. Okay, that is all right. So they haven't got data on their long-term liabilities at the moment. Move on to cash flow. Of course, we want to see this increasing, and we can see here that in 2017 they did $8.7 billion, and now they did 9.5, check mark there. They're growing their free cash flow. And now let's head in here to the 8 pillars, because there's a lot of checks here. You can see their their return on invested capital is greater than 9, which is a check mark there, not a lot greater. Revenue growth, massive revenue growth. They have net income growth. Their shares outstanding is staying the same. We can't calculate their debt right now, how much debt they've got, so really figure this one out. I should probably also have included the financial report here. But now let's just continue here. The cash flow is growing. But the only two X's that we have here are the 5-year PE is greater than 22.5, and the 5-year price to free cash flow is greater than 20 by a lot. But if you look at the PE ratio at the moment, it's 26.5, so that is significantly lower than the 36 we were looking at here, and that is actually starting to get down to that 22.5 that we want. So what I'm going to do now is going to go into the stock analyzer tool and put in my assumptions about the future. And what I want to say right now is, although you probably think that this sector is going to grow tremendously, which I also think, and that is why I'm looking at this company, because I'm conducting research about companies that I'm interested in, sectors that I'm interested in. But you can see the past year they have grown their revenue by 18.5%. And the thing is, that is not sustainable. That is because of this whole crash we have had with the shortage and the demand for these semiconductors going up so much. Still think there's going to be a lot of demand in the future, but we have to be realistic. And what I'm going to do here is I'm going to put in 11, 12, and 13. And the reason I'm doing this is, in these 13% over the past 10 years, this 1 year is baked into the average. So that is why I'm going a little bit lower than the 10-year actually. No, maybe I should actually, that is probably not doing this justice, to be honest. I'm going to move this down to, yeah, like that. Okay, so now it's probably more reasonable. With an average 15% year-over-year revenue growth, and they do like 55 billion, that's like 120 billion dollars in revenue. So I think 15 is probably, yeah, it's good. We have to put in some conservative assumptions because we don't know what is going to happen, and it is our job as investors to find these just great deals where it's just amazing value that you get. So don't buy it if it's just on the edge. That is what I would recommend. That is what I would recommend. But let's go here. Let's go. But here, let me go 35, 35.5, and 36. And because their profit margin increased the past year. Okay, so actually I'm going to go 19, 20, and 20.5. And for the PE ratio, guys, this is a large cap stock, a mega cap stock, $500 billion. So you have to think about when the company grows even more with 15 year-over-year with a 15% revenue growth over the next 10 years. That is going to be a huge company. So they can't demand that high of a price to earnings ratio because they just haven't got that much growth looking ahead when it gets when the market cap increases. So I'm going to go here. I'm going to go 14, 18, and 22, and I think that is reasonable. If I were to like really go complete bull, and which I don't think they're going to hit this, but then I would probably go like 15, 20, and 25. So we can try that after we see what this gives us. So I'm putting in here 12.5% desired annual return. And the reason for this, S&P 500 has over the past century done an average given an average return of 10.5%. When you're investing and taking your time to invest in individual stocks, then you want to make it worth your while, basically. So that is why I'm putting in 12.5% here. Hit the analyze button. Right now, I would probably wait for it to drop a little further because, but still, right? If you look at the stock price, man, it's been flat. It's been flat over the past year, while they have been growing their revenues, growing their earnings, all these things. So it's hard to say, but let's just try and go with this that I talk. But let's just try to go with 15, 20, and 25. like that. Then let's see what we get now. So then you can see then it's even a better deal, but still, if we take into account the discounted cash flow value, then we still have a red in both the high, mid, and the low. So yeah, I wouldn't say this is a clear deal, just a great deal at the moment. I'll probably put an alert on this and see if it suddenly drops a lot, then I would probably go in. On Yahoo Finance here, we have 6 analysts for this year's EPS estimates and 5 analysts for 2023. The average estimate for this year is $5.6 in EPS. So I'm going to pull up my calculator right here, and let's calculate if they stay at this 26.5 price to earnings ratio. What can we expect here? So we have a 5 point. This is their EPS, and then I'm going to time that with their price to earnings ratio, which will give us the price. If they stay at this price to earnings ratio, the 26.4, and they do this EPS that analysts expect of them. So let's calculate that. Well, the fair price, the price if they can keep their price to earnings and do those estimates, then it looks like a buy. So you can see that is the price we will be looking at, $148. Right now it's at 100. Let's see for next year. So 2023, they should be doing $6.44 per share in earnings, and if we time that with their PE, which this is a high PE for a market cap, $500 billion market cap. Let's just do this now. Basically $170. So if we then put a little bit of a more moderate price to earnings ratio in there, so let's say they do the average estimate for 2023, and their price to earnings decreases a bit because the company gets bigger. Let's say it is like at a 24, okay? Still a buy. So kind of what it seems is if they can just like keep their PE relatively steady and they can do these estimates, we're looking at $150 for TSMC. But for myself, I'm not going to buy TSMC because I would simply like my price targets here in the stock price, here in the stock analyzer tool to come out better than they do. I'm not going to go any higher on the revenue growth. I'm not going to go any higher on the price to earnings ratio here. You have to think about this is in 10 years. I would argue that in 10 years, you're not going to see TSMC trading at a higher P than 25. That's just not possible in my mind, to be honest, because unless like they completely crash or something and get down to like a penny stock, well, then it could be possible. But if they grow with what is expected of them, they're not going to trade above a 25 PE in 10 years. That's just not going to happen. So yeah, 25 is also kind of pushing it with the price to earnings ratio, and still we don't get like pure green down here, so that's why it's not a complete buy for me.